Folks, this is the last part of a four-part video series. We talked about option volatility, we talked about historic volatility, and now I'm going to talk about delta, and I'll put everything together for you. And I'm doing this in a very informal way to give you a very good sense of how things work. I can get really mathematic and I can start drawing figures and decimals. I don't want to do this. I want to make this very user-friendly, and I hope you appreciate that. It's not because I lack the understanding of this, it's simply because I don't want to get too advanced because it'll just throw you off, and I'm not interested in that. So let's talk about implied volatility very quickly, historic volatility very quickly, and then I'll get into delta. Historic volatility, nothing to do with options. It's simply the historic volatility of the underlying asset, okay? When that volatility changes, the historic volatility changes. Implied volatility is the change in the options price based on that expectation change in the underlying asset's volatility. So all implied volatility is change of expectations by the traders. And how is it reflected? By change in price. If the volatility is higher, if all of a sudden the stock begins trading $20 or $15 a day and before it was trading $5 a day, that means volatility is higher. That means there's higher odds that the option will increase in value. So that option will be bought up. It'll be increased in price. Buyers will go ahead and increase the price. They'll rally that option because they believe there's more value in that option because the stock has more trading range. So historic volatility, change in the historic volatility of the underlying asset, nothing to do with the price of the stock, nothing to do with the price of the option. Implied volatility, the perceived change in the price of the option based on the historic volatility. And a lot of times what you're seeing is you'll see traders or gurus say we look at historic volatility and we look at implied volatility and we look to see if the implied volatility is higher than historic volatility. And all they're saying is they're looking at the implied volatility like a reflection mirror. They're looking to see what it reflects. And they're looking to see if it reflects more than the trading range that the traders are seeing in the stock right now. So if the traders are seeing a $5 volatility in Microsoft or whatever the stock is, and implied volatility after it's put in through the Black-Scholes model and it's dissected, if the implied volatility is saying we're pricing this stock as if the volatility was $10 instead of $5, that means implied volatility is too expensive compared to historic volatility. So what you're doing is you're looking at the actual volatility of the asset and you're comparing it to what the traders, based on the price of the option, are implying based on that price that the volatility will be in the future. So if historic volatility is $5 and implied volatility is telling us it's $10, we know that implied volatility is overvalued, okay? Because historic volatility is telling us it's 5, and implied volatility is reflecting the price of a $10 swing instead of a $5 swing. So that's how you look at historic volatility and implied volatility to see whether historic volatility or implied volatility is ahead of the other. And ideally, you want implied volatility to be on the same level as historic volatility or cheaper when you're buying. I hope that helps, and in the next video, I'm going to talk about delta. I'll tie in delta to implied volatility, explain to you the difference between delta and historic volatility, and we'll round everything off. See you in the next video, and make sure if you like these videos, if you're getting something out of them, make sure to like them below this video. Talk soon.